Good afternoon, everyone. This is Joe Gordon. It's Tuesday at noon. Today's Tuesday, September the 1st, and this is our weekly update. The disclosures here, same every week. We're not giving investment advice, tax advice, or any advice, but merely just informed opinions about what's going on and information for you to digest all in one place in less than 25 slides in less than about 25 minutes. You can follow us on YouTube. Just simply go to youtube.com and do a search for Gordon Asset Management, LLC, and all of these presentations will come up, and so you can look at them at your own leisure, but obviously the more current ones are the most fluid because it's up to date about what's just happened. You can also sign up at wealthqb.com. So coronavirus update. We usually have about 2 slides now on this, although anecdotally there are some things in the news overnight and this morning that are worth mentioning. But again, you can see total cases just under 6 million in the purple line. You also can see deaths, 175,000, and then you can also see currently hospitalized a little over 35,000. But the trend is good. Decreased hospitalizations, a second bullet, and the deaths did not climb all that much in the last week. One anecdotal thing is the CDC, Center for Disease Control in Atlanta, quietly updated on their website that only 9,210, I believe is the number, deaths in the United States are directly due to COVID-19. All of the others are complications from folks that had other illnesses, and the COVID compromised that, and they passed away. So pure deaths, 9,210, and again, mostly people over 65, which tells you why college kids really didn't care what people said about having parties, because they knew that their mortality rate is hardly even worth talking about. But nonetheless, people are online, especially at North Carolina, NC State, and East Carolina. I was glad to see that North Carolina AT&T has gone the opposite way. They have 70% of their students in class, which is good. So confirmed cases, you can look at this graph, daily increase on the left. In cases, you can see Latin America and Southeast Asia are having the biggest spikes. The trend in North America is down. Trend in Europe is up again in cases. So that's a second wave type of thing people are saying. Daily increase in fatalities, you can see essentially Europe, by shutting everything down, has totally got that going well and still flatlining for the most part. Spikes are in Latin America in deaths, and then also Southeast Asia. Again, North America, it's been, spike down, then a hot spot start, then partial shutdown economy, and then we're trending in the right way down. So let's look at how that affects stock markets globally. The Europe-Australia Far East Index is down only 6% year to date. And again, that index is developed markets outside the U.S. And then if you look at emerging markets, they keep clawing back, although they fell a little bit last week. They're down just over 1% year to date. And a lot of the rally in emerging markets is directly correlated to the weakening dollar. It's been down 5 weeks straight. On global aggregate bonds, are still up 6% year to date. So for folks that are in fixed income outside the U.S., that's the positive. Then we get to the wild west in the U.S. market. The S&P gained a little over 2% last week, putting it at just under 8.5% year to date. The NASDAQ, where all things technology and biotech are, gained 6%, 6.33 to be exact last week, and now are up just under 40% year to date. Some people would say things have gone parabolic. And then the little measly Russell 2000 index of small cap stocks fell a little last week and is still down 6% year to date. One anecdotal comment I heard this morning was that the market cap of Apple after yesterday's close now exceeds the entire market cap of the Russell 2000 index, all 2,000 stocks. It also passed the market cap, or I think the 5 megatech stocks in the U.S. are bigger than the entire Euro stock exchange. So anyway, Barclays Ag still up just under 7% year to date. Rates are zero bound, and so forth. And so you can see here the graph. Obviously, the Nasdaq way outlier as far as returns. Then you look at the gap, okay, so what is it about the index? So NASDAQ's up just under 40, but if you look at orange equal weighted NASDAQ 100, if you equal weighted every stock, it's only up 21.69, which tells you that it's not all stocks in the index carrying their fair share, but a certain few are doing it, the five megatechs as we talked about. And you can see the same thing in the S&P 500, up 8.5. But if you equal weight the S&P 500, the index is down almost 4%. Again, the tech components are carrying the day. So let's look at US market caps revisited. Here are the five megatechs: Apple, Microsoft, Amazon, Facebook, and both share classes of Google, which most people refer to now as Alphabet. You can see the rally last week: Apple, Facebook up over 10, Amazon up over 9, Microsoft 7, Google over 2.5. And if you want to look at any one of those and say which one's probably got any value, it's probably Google. But anyway, so that's really it. And you see here graphed is just the returns year to date, 89%. Amazon, Apple's closing in on it. It's almost 79% up year to date. And then Facebook up 45, Microsoft up 43.77, and then Alphabet 22%, 23% both share classes, and then the last is the S&P 500. So clearly these five stocks have carried the day. S&P valuation, again, you can see the tech bubble over here, 99,2000 at 20 times, exceeding 24 times earnings on the S&P, and now we're at just under 23. But again, it's really not the index I talk about. It's if you take out the five megatechs, then the rest of the S&P 500 is not trading anywhere near that range. Inflation in gold. So really, when you look at gold, is up 29% in U.S. dollar terms. If the dollar continues to weaken, gold will continue to go up. And then inflation is really benign at just under 1%, in spite of the fact we have a 20% expansion of the money supply. But CPI index inflation is a lagging indicator. The other thing in this chart worth mentioning is offsetting the increase of money supply is the blue line, the velocity of money supply. That has fallen off a cliff starting in March, and it is not recovering. It's still trending way, way down. So if the velocity of money doesn't pick up, then it really offsets the increase in money supply as caused by all the Fed liquidity. Okay, so you can see here again, inflation is a lagging indicator, but it's not showing up in the data. The Fed has even said, Jerome Powell last Thursday, that we don't really care about inflation anymore. I guess it's because they couldn't do anything about it in the first place. But now they're only going to worry about full employment. And since the unemployment rate's over 10%, that's what they're going to focus on. It was around 3.5% prior to COVID. And then here's a little graph or slide about what the Fed said. So essentially, our revised statement is maximum employment. That's our broad-based and inclusive goal. So here's another thing. Houses are going up. Some of the biggest increases in housing sales in history going back to 2006. We had in a slide last week. But supply is getting really tight, not just in the big city markets on the coast, San Francisco, LA, New York. If anything, those cities are having a real estate depression from exorbitant prices. A lot of people moving out of New York and not coming back. But if you see here nationally, the price of lumber since a bottom in April 20th is actually way up. So the cost of framing lumber, a huge housing component of cost, is gone up. Here an estimate for the new single-family home, raising the price by $16,000. But record low mortgage rates are dampening that effect. So we've looked at this slide in the past. This is a good slide to kind of tell you where things are. So you can see here in this dark blue line, purchase money mortgage applications. It's obviously trending way up over 20%, probably closer to 30% increase, 33%. And then you look at the next in purple, how about credit transactions and debit? Way down after COVID, and you can see way, way down, almost 40% in March. But now nearing back to where it's not down all that much, maybe down 7%. As we see up here. Hotel occupancy, we're still off 30%, was down 69. People still aren't traveling, is down 42%. And then people seating in diners down 52%. Makes sense because most restaurants are not allowed to operate at more than 50% capacity. Then lastly, travel with TSA data down 57%, which is why you're hearing a lot of airlines talking about laying off people and pre-announcing. So U.S. employment here, continuing claims is still in the 14 million range, down from almost 15 million the prior week, 14.5 million. Initial claims fell to 1 million, down from 1.1. That's in the right direction, but there's going to be more to come as companies rethink what their staffing needs truly are in a stay-at-home economy. And the current full-time employment rate's at 10.2, down from just under 15% at 14.7 at the March lows. So clearly, things have been trending there, but they kind of are flatlining there when you really look at the employment rates in the right direction, but it's not getting below 10. So today we thought we would focus on, we're getting a lot of inquiries from our clients and other friends about what do you think is going to happen with the election and how it will impact the market. So the rest of the slides are pretty much going to focus on that. And one of the things to know, if you invested $1 in 1926, and this is Morningstar data, they own Ibbotson. Ibbotson was famous for always publishing the annual yearbook, but this is that kind of data. 1,026, you were buy and hold. It really didn't matter who was president, blue or red. As of June 30, that $1,000 would be worth 8.96 million. Now, clearly, that does not consider the human behavioral aspect of touching the money and spending some of it. But the trend line point is just to make sure you know that the trend is your friend. It really doesn't matter who's in office politically. If you look at how stocks have done across election cycles, all years up 10%. This is large cap. And then if you say, well, what happens in presidential election years? Up 11.3. How about midterm elections? The average is up 8.6. How about in non-election years, like odd years, no midterms, no presidential? That's the best, 14.3. And probably that's because people are not reacting of things they have to do to get reelected all that much. Generally, investors build up cash in election years, and especially this year. You can see from 1993 through June 30 of this year, in presidential election years, they're building up a lot more cash, 114 billion on average to 56 billion. If you look at stocks and bonds, it's mixed. And then if you look at flows on money funds this year, a lot of people hoarding money. They're scared. We've had a number of clients call us and say, I don't really care. I can't sleep at night thinking about being fully invested with how crazy things have gotten this year politically. So I just want to go to the sidelines. And funny thing, a couple of our clients said, well, you know, I'll keep some of the 5G indirect plays on cell towers, and maybe I'll keep a Sin stock or two like Constellation Brands, which Corona Beer is their big beer brand. Anyway, but you can see flows are negative on stocks and bonds this year. So what about new versus incumbent presidents during cycles? This is from data from 1928 through 2016. When a new president is elected, the market's up stocks are up 9.3% on average, bonds 6.7. Bonds are up about just under that this year. What about all presidential election years? What are stocks up 11, and then bonds up 5. And then when you have an incumbent win, on average, stocks are up 13.4, and then obviously bonds up 4.2. And it's important to remember in 2016 there wasn't an incumbent. It was Hillary taking over for Obama on the Democratic side. All right, so now let's look at asset class performance during presidential election years. Here's an election year average by asset class. Technology during election years, not so much. And this is data from 1980 to 2020, so 40 years of data. But if you look at technology, 1 year after the election, up 17. You get a Republican president, up 8. Democratic, up 27. Year-to-date tech is up 14, but the mega techs really skew that. If you look at large growth, similar story. 1 year after the election, up 17. The averages and all that growth during the election year average. Republican just under 9, Democrat 17, and so forth. And the irony is that when you look at the best performing sectors in election years, real estate, small caps, financials, and energy, on average the highest. They are the worst sectors this year, and you can see that over here. So who knows? Maybe this is a different year. We'll see. So what are we watching? A few things. You've got obviously COVID, and again, the CDC admission last night on their website that not less than 10,000 people in the U.S. have actually died directly from COVID. So we'll see how that plays out politically and in the media. And then you've got the election. We're less than 90 days. I think we're pushing to pretty soon the 60-day mark. And then you've got new stimulus. They're still at an impasse. The House with Pelosi still says what I heard the other day, we came down from 2.4 to 2.2 trillion, but that's nowhere near what the White House with Treasury and Steve Mnuchin are saying. They don't want any pork. They want it strictly all COVID related. So we'll see what happens there. And then you've got inflation and money supply expansion. And what's interesting here, there is no real inflation, but the dollar weakening is basically going to be good for gold. It's good for commodities. It's good for metals and miners. We have a number of clients that have a hedge on with that, even though they have sleeves of technology and stay-at-home stocks, but also are hedging over here with treasuries, but also metals and miners. Social unrest is a big issue, and we'll see what happens. I doubt anything much is going to happen before the election. And then obviously market breadth. The thing concerning us is this a secular bull market new rally, or is it a bear market rally? And obviously, you take the 5 mega techs and add a few more stocks to the fray, and you see crazy returns. Zoom reported earnings last night and smashed estimates. And then also, and that was for the period, the quarter ending July 31. And then also DocuSign, I think, is reporting this week, and their stock's up crazy today, and based on it's selling at a huge multiple of sales, not earnings. And then you also have dollar strength against the euro. It's actually weakening. It's weakened 5 weeks in a row. And so what that means is that gold will continue to do well, and so will metals, miners, and other commodities. Copper is up 45% since a inter-year low in late March. And then also emerging market equities tend to do extremely well when dollar weakens. And then you got the old growth and value debate. One thing I will tell you is that anecdotally is that sectors like utilities and REITs are way oversold. So is energy. You can get dividend yields of 4 to 8% or even more with very good sound balance sheets and stocks. So that's an area we're looking at for our clients. And we were in there early and then took some profits, and now probably going back in again because they're basically been given up for dead as everyone chases tech. So lastly, on the 5 mega techs, here's a couple things anecdotally. Let's talk about Apple. Its market cap's up 126% the past year, but guess what? Sales are up under 6%, profits are up under 5%. So you say, okay, that year doesn't make a long enough horizon. Let's look at 3 years. The stock's market cap's expanded at over 36% over the last 3 years per year. Earnings are up 7%. Sales are up. Earnings are up just under 8%. Sales are up 7%. And then if you look at Amazon, it's up 94% year to date over the past year, actually, and it's dwarfs their 28% increase in sales. So they do have high increase in sales, but it's only 1/3 of what the stock price is doing. And then let's talk Tesla. Its market cap's up 920% this year. Just think if you put $100,000 in at January 1, you got $920,000 today. But sales are up 3%. So how does a stock go up 920% if sales are only up 3%? If you look at it over 3 years, the market cap soared at an annual rate of 91%. Sales are up 37%. NVIDIA, another great chip maker company. Its market cap in the past year has gone up 218%. Sales growth 28%. On a 3-year basis, market cap up 47%. Sales growth compounding at 16%. And then the last two, Netflix, interesting, up 80% year-over-year growth in market cap on 28% growth in sales. And then you've got Microsoft, another great mega tech company, market cap up 65% in the past year on 14% sales growth and 13% earnings. And so the conclusion of that is those stocks are getting way ahead of themselves, and basically they're priced for perfection. So as we tell clients that ask us about them, if you own it, fine, keep owning it, because they're defying gravity. I wouldn't buy them today. If you like Apple, we might even say buy Berkshire Hathaway. They got a ton of Apple, and their stock price is not even hardly up here today. So with all of that, if you have questions, want to talk about anything, please feel free to contact us. And we look forward to continuing the discussion. Thanks, and have a great day.